Thanks for joining us today on Market Call. I'm Morella Fernandez. Lyle Stein with us on the show, president of Forvest Global Wealth Management. He'll take your questions today on North American and global stocks. Here's how to reach us. 1-855-326-6266 if you want to dial in. And if you'd like to email marketcall@bnnbloomberg.ca. Well, good to see you.
Nice to be here.
What's your take on the markets as they have started off the year, the first couple of months of 2026?
Oh, my goodness. What a ride. I mean, holy cow. We've had a country takeover. We're still in the midst of a major war, two wars maybe if you include Israel. And now we've got what's going on in Iran. You got the Fed and all kinds of discombobulation. Tariffs are on, tariffs are off. What a 3 months it's been.
Have you ever seen anything like that?
Not that I can recall. Not anything in terms of geopolitical volatility than what we've gone through in the last 3 months.
Okay, we've got a ceasefire that seems to be holding in the Iran conflict, but we don't really know. When you're looking at the economy in a wider way, what do you see as the biggest threat to economic growth? Is it this Middle East conflict?
Unquestionably. And I think the unintended consequences, the second and third derivative effects of what's gone on over the last 30 plus days, we still can't even begin to think about. I mean, the ships that were moving crude, natural gas, fertilizer that left 37 days ago are now in ports, but there's nothing coming behind it. What's that going to mean for global crops? What's that going to mean for production of all kinds of things? What's it going to mean for gasoline prices in small emerging economies? They are really hurting and really struggling. So I think to say, well, we're going to tick a quarter point off GDP or half a point, we just don't know at this point. And again, it's a very, very fragile ceasefire. I mean, when you look at the two sides, I wouldn't want to handicap an outcome.
No, we've talked a little bit about that for the past couple of days, that there have been lots of deadlines that have passed and lots of threats that have been made. So even when you say there's a ceasefire, there's no guarantee it'll hold.
No, exactly. And as an investor, you can get caught up in the noise quite easily, right? I mean, oh my gosh.
It's hard not to, right?
Yeah. But when you think about it, what has happened? Well, oil prices are going to be higher, everything else being equal going forward. Insurance is not going to cost the same thing as it did in February and before. We know that, that's certain. Will there be tolls? We don't know. They're talking $2 million a ship that goes through. Okay, that's an increase in the price. You put all this stuff together, oil prices are now higher. That has an impact that will carry on. Again, we don't know exactly. Look at semiconductor manufacturing. They need helium. What is that going to mean? I mean, it's really hard to tell, but I think basically costs globally have gone up and growth implications have to be ratcheted down. And I don't think the market has factored all that in yet.
I do want to get to one more comment from you, because you say investors should look at HALO, but remind us what that is.
HALO, hard asset, low obsolescence. In this kind of environment, cash flow is king. The best cash comes from a hard asset that you can determine a value of, look at it, and actually value it on what it's producing in terms of revenues and then ultimately cash flow, dividends, and the like to the shareholder. Low obsolescence basically means they've got somewhat of a moat around them, if I can steal that term from Warren Buffett. Nobody can replace it in the near term. It's not going away. Those are the kind of assets you want to hold in uncertain times. Get paid with that dividend, and if growth comes, that's great, but it's going to be there 5 years, 10 years. We're not worried about 5 days or 5 weeks or even 5 months. These are the kinds of things that kind of basically survive all kinds of uncertain times, and we're in one, as we talked about earlier.
All right, let's take a quick break then. We will line up the first phone calls for Lyle Stein, Forvest Global Wealth Management. I'll take your questions on North American and global stocks. Here's how to reach us today. We're back in just a moment. Stay tuned. Welcome back to Market Call. We have a question from Sam that has been emailed. He says, your guest view on Microsoft. Let's take a look at the Microsoft line chart, see where we are today. A lot of the tech stocks, the big ones, have been pushed back and are barely recovering. What would you do with Microsoft today?
Boy, that's a tough call. We don't own Microsoft.
Okay.
I like it more today than I did back in November. Microsoft has rolled over since the peak in technology shares late last year. NVIDIA has gone basically flat during this period. The Mag 7 names, there's a technical term called, they're tired.
Yeah.
They're just tired. And Microsoft is suffering because it doesn't quite have the same, I would say, sex appeal that a AI chip manufacturer might have. It doesn't have a specific product that it can basically
Hold up and say, this is all about AI.
yeah,
And it's new. Yeah.
and it's not a cheap stock. When you look at it, its growth has not been stellar, and so its multiple is contracting, and that is indicative of a tired market. And we can get into that later, maybe if we talk about stagflation. But this is exactly the kind of stock that Microsoft is. It doesn't do well in this kind of environment. Everybody owned it, and when everybody owns a stock, who's left to buy it if things start to go a little soft? And I think that's what's got Microsoft down 30% from today.
It does have Copilot, of course, which it's embedded in all of its software. So people who use their Office functions do have access to Copilot. Not enough. I see you shaking your head.
Copilot's good, but Claude is even better. So, I've got sometimes I have to call the law firm of Copilot Claude and Gemini.
And they can collaborate together. Yeah.
Oh, it's wonderful and compete.
Yeah.
It's a wonderful tool. I don't find it as robust as Claude, but nonetheless, I use Bing as my browser, so it's there and it's a go-to thing. But how do they monetize it? And that's the big question. And I think that question is going to hang over the market for at least a year.
Okay. Let's go to our first caller then. Bob's on the line. He's in Bowmanville, Ontario. Bob, go ahead.
Good afternoon. Lyle, I just want to ask about Novo Nordisk. As we know, short-term, long-term, it's been beaten up quite a bit. I guess its best comparison for many is Eli Lilly. Lilly, on the other hand, has done well over time, I guess, much better. And, is either of these two a buy right now, or kind of your thoughts on Novo, but both of them, I guess?
Okay, thank you for the question. I know they compete in the whole sort of weight loss drug, but would you pick one over the other, and why? Perhaps is Novo not bouncing back the way Eli Lilly seems to be?
Yeah, Novo's an interesting name. So we have owned it in the past. We don't own it today. In fact, it was a tax loss selling candidate in 2025. We made money, then we rebought it, sold it, put our toe in the water in early 26 after we took the tax loss, and that didn't really play out. We're out of it. And the reason we're out of it is that there's just not any clarity with respect to its ability to grow that U.S. market. And that's Eli Lilly. You've had a management change at Novo Nordisk. It's a cheap drug stock. There's no question about it. But what is the staying power of these weight loss drugs? Ozempic, Wegovy, Mounjaro. They're all were started with prices at $1,000 a month, and those prices continue to fall. How do you value that is the uncertainty here. At this point, I think just let the chips fall. I think it's going to be a hard way to make money until we get further clarity on how much is going to be paid and what happens as more and more consumers go to something like Trump RX to purchase their drugs. It's one we'd stay away from at this point.
Okay. Let's move on to our next caller then. Rob's in Calgary with a question. Rob, go ahead.
Hi, thanks for taking my call. I have a two-part question. I'm interested in the precious metal space, and I'd like to get Lyle's opinion if it's a good time to get in, or if the big move's been made and I'm too late to the party. And secondly, if Lyle still sees some runway ahead, how would he invest in this sector? Would you buy the miners directly? Would you participate in an ETF or hold the bullion, or maybe as a different approach might be investing in a company like Sprott? Thanks for your advice, and have a good afternoon.
Okay. Where do you land right now on precious metals? Is there a metal you would pick up today?
Yes. And let's take it in two pieces. How much time do we have here today?
It was a wide question.
So let's just take it right from the top. We have been holders of precious metal stocks. At one point, when I was on the show, I think we were 28% in precious metals holdings. The way we look at it is in two parts. Precious metals should be in every portfolio as an insurance policy. It's called basically portfolio insurance. So that's component one. We use bullion as that play. Then you have the leverage on bullion, which are the shares for all practical purposes. Now, in between, you could have something like Sprott that runs an ETF, or you could have a streaming company which collects royalties off of the operating company. So there's this hierarchy. You got bullion, you've got the miners of bullion, the royalty companies on bullion, and then you got Sprott that's an asset manager that's related to bullion. We've owned all of them. Where we are today is we've trimmed back that gold position dramatically by reducing names. Agnico Eagle hit a 10% in our holdings. It's been a great holding. It's not 10 today, it's only 6, having taken profits and seeing a little bit of a gold market hiccup. Sprott we owned. It had been a great performing stock. We were on that story early. When we took our weight down, Sprott was one of the vehicles that we used to get our weight out. We also had exposure to wheat and precious metals. We took that off. We had exposure to silver. We took that off. So that's how we got our weight down. Where would we be today? I think you have to have the insurance component. There's an old line that
So some gold.
You should have some. Great line that I heard early on from Brian Steck, the old CEO of Nesbitt Thompson. So I'm aging myself here. Every portfolio should have 5% in gold and hope it goes to 0.
Interesting, because everything else will go up. Got
Bingo, you got it. It's a diversifying thing. What happened over the last 2 years has been wonky.
Yeah.
Nobody could predict that the price of gold would go from 2,000 to 5,000 in such short order, but it did its job. The war. People say, "Oh, it hasn't provided its job over the last 35 days." No, it did it over the last 2 years. If markets anticipate, markets did very well in gold. So we would be buyers today.
And in what way would you dip in?
Okay, so first of all, you got to go for the insurance component. The insurance component, in our thought, should be 10%. Our clients today are 8%, so we're not quite fully there. The equity component, 7%, so 8 plus 7, we're roughly 15% in golds today. Playing it through Agnico Eagle and Franco-Nevada as our gold plays. So that's how we're doing it. We don't own Sprott, to answer your question specifically, but you're on the right path, and there's nothing wrong with Sprott. It's just a waiting call as opposed to a stock call.
Let's take a quick break then. We have Lyle Stein here with us today to answer your questions on North American and global stocks. We're back in a moment. Welcome back, and thanks for joining us. We have Gordon on the line in Victoria with a question today. Let's go there. Hi, Gordon.
Good morning, Morella and Lyle. I wonder if you can recommend a preferred share that resets, that balances the desire for a superior yield with the equal desire for a conservative credit profile.
Thank you for the question.
Thanks. That's a great question. You've just talked about another 15 to 17% of our client portfolios. We've held preferred shares for a long time. They've been spectacular fixed income investments. Some people think they're equity. Some people think we're bonds. At Forvest, we're somewhat asset class agnostic. We look at returns in terms of how much cash is generated and what is the growth profile, if there is a growth profile. When we look at the preferred share market, I've got a list of names. I'm very hesitant to recommend one specific, but one we've held for a long, long time is the Enbridge US dollar pay preferred. It's got a wonderful yield. It's better than Enbridge Common. Any preferred that you can get, and I wish I know the price of it off the top of my head, but if you can buy a preferred share at a discount, so $22, $23, you have some upside potential should it be taken out, and we've seen a lot of these preferred shares taken out. So what I would do is just go into your computer, go on a research piece, and scan the names. Again, if you look at the kinds of names we own, a lot of pipelines in there. We've got some financials in there. They're good income sources. You get 5.5%, in some cases even 6% on the yields. So it's kind of how does it fit in the context of your total portfolio as opposed to this one is the best idea. We're always looking in the context of total portfolio.
Hope that was helpful to Gordon. Let's move on to Stefan in Montreal. Stefan, go ahead.
Okay, I'd like his comments on the Canadian oil patch in general, but I'm looking at two stocks in particular, Whitecap and Baytex. And I would like to have his comments on, I know there's been a pullback recently. I'm expecting to have maybe more of a pullback if this thing gets resolved in Iran, but would he go in at these levels and maybe a comment on maybe a choice in the Canadian oil patch? Thank you.
Okay, so Can you broaden out for a moment? I'm wondering what you would do with energy today if you're coming in and want to put some money in energy, considering how volatile it's been lately, considering where we are today. What would you do?
Okay, it's a good question. We have about 10% of portfolios and producers, all with a gas bias. So
why did you go that way?
We like natural gas. We think it is a long-term solution to all the green problems in the world. We think that the stability of the market demand from data centers and all the rest is there. We just think gas is the perfect intermediate fuel between now, today, and nuclear power sometime down the road. So we're levered to gas. But specific names to oil, as an investor, your head can go spinning trying to figure out what the oil price is doing today, tomorrow. First thing we look at is the futures contract. And, it's a fascinating picture. Oil spiked at, I don't know what, it hit 110, 115. Today it's a little bit under 100. But look at the oil futures contract for December. It's gone down for the last 2 months. It's not discounting a high price going forward. So as an investor, when we value companies, we're valuing them more off that long-term price, that futures price, than we are off the spot price. If 120 stays there, it won't matter what name you throw at me. Yeah. They're all going up. But from an investment perspective, now the question is who can make money and who can do well. We've owned Whitecap in the past. I think it's a really well-run company. We like the management team and their ability to grow that company over time. It's also a smaller cap stock, so you can get some multiple expansion. You can get that kind of appeal when money starts to flow in. So that's a great name. But as I said, we own gas-levered stocks, Vermilion coming top of mind. Peyto is another large position.
Because you prefer to play it that way. Okay.
Yeah.
Let's get to George then. George is on the line. He's in Halifax with a question. George, go ahead.
Yes, thank you very much for taking my phone call. I'll be very brief. What's going on with Telus? Is it a good time to buy it now or not? And I will hang up and listen to the answer. Thank you very much.
Thank you for the question. New leadership for Telus. Concerns about dividend. We get those questions quite a bit. What's your take?
We don't own any communication stocks in Canada, and that's more a national call than it is stock specific. Basically, our view on telecom in Canada is that it's a slow growth at best business. The dividends are good, but the dividends are at risk. We saw it with BCE. Telus has done whatever they could to maintain that dividend. With a management change, if I was the CEO and I came in, that would be high on my pecking order in terms of restructuring this company for going forward. So again, it's a stock we don't own. I wouldn't look at it just because I'm not a big believer that telecom is the growth business for the next 10 years than it has been for the last 10 years.
If you were holding it already, what would you do?
Oh, that's a tough one. You need a tax loss candidate? That's a perfect one for it. And you know what? If it pops up, that's great. There are much better fish to fry out there.
Let's move on then to an email from Alan. He says the big U.S. tech companies have taken a real hit over the past few weeks. What are your thoughts about starting to nibble at, for example, Amazon? We did touch on Microsoft when we started our conversation today. Where are you with Amazon? It does have more appeal, I guess, in a certain way with its product offerings.
Yeah, we had started the year owning Amazon, and we peeled it back because we got concerned about the market in general. Amazon is an interesting play because of its wonderful consumer business. Mm-hmm. And when we looked at Amazon, at the beginning of the year and last year when we bought it, we saw a consumer business that was trading at, half the valuation of a Costco. Made no sense to us. And then you have their technology, the AWS.
Web services, yes.
The web services is a fabulous business. Now, the concern we had with Amazon is like that for other hyperscalers. They're spending all their cash flow on building these data centers, and not everybody is going to be a winner in this. I wish I could handicap the winner. We think natural gas will be a winner because ultimately they're all going to need backup power, and it's going to be natural gas fired. They can't get on the grids. It's a natural gas firing that's going to generate it. We would much rather own, the arms merchants than the armies, and I would classify Amazon in the army. So it's tired, like we talked about with NVIDIA and Amazon, or Microsoft over in the call. Again, it's a name. It's interesting. If the market wants to go higher, all these names are going to go higher. We just struggled, as we talked at the opening, about the valuation of the market.
So you're playing outside the Mag 7 in other ways.
Yeah. We've got we'll talk about one of the top picks. We own Google. We think Google is going to be a winner through this piece. You got to have some exposure from a portfolio diversification perspective. You can't try to just pick the winners. This is 30% of the U.S. market, 30% of the global market, even more in the U.S. You got to be there somehow. Again, just like you got to have sort of 10% in gold, you got to have some in technology.
Let's leave it there for now. We're going to come back with Lyle's past picks. Stay tuned for that. Welcome back. Time to go through past picks from Lyle from July 18th of last year. At the time, he chose Agnico Eagle, AEM, on the TSX at 117.13. We know what gold has done, made somersaults since that point. 216.27 today, 84% upside, 85% total return. Gold has come off in more recent months. So did you trim on this?
We did. Stock gets to 10% of the portfolio, we peel it back. And this stock, I think we had to peel back twice because it hit 10% twice. It's still, I think, the largest equity holding in the portfolio. If not, it's number 2. We like this company. We think it's a great company. We think that the management team has got a plan in place that makes them a great business, not just a gold mining company. And we also like the fact they're diversified in safe jurisdictions. So it's the go-to name. If there's any knock on Agnico today, it's trading at a higher valuation level than some of the other golds.
Do you know what it's about?
Yeah, I think it's 17 times earnings. Okay. You can buy Newmont at 11 or 12. That's the quality. And you know what? As long-term investors, having a quality company is how you make money in the long run.
You mentioned you trimmed. You trimmed back to what?
8.
8.
Yep. And then we trimmed back again, and then the gold price decline and the stock decline. I mean, I think it was trading, at 300 or north of 300. It's come down. That's okay. It to us is just a great place to be as the leverage off of our insurance policy.
That was Agnico. Let's get to your next past pick, AMD on the NASDAQ, AMD. 156.99, just short of 157 US at the time, which was July of last year. Now to 233.16, so 49% upside for return and total return as well. This is a tech pick. Did you keep your money in this particular tech stock? What have you done with it?
We peeled it, unfortunately. We didn't get that full gain. You can see on the chart a bit of a dip late last year, and we trimmed out. And the reason we trimmed out is that we have stop loss rules. And so we just said that's it.
So you would have trimmed out around what you think, 185?
Yeah, it was in the it was in probably the low 180s kind of thing. Anyway, it's a great name, but as a portfolio manager, we have a rule that if stock falls 20%, you either buy more or you sell it. A hold doesn't cut it because you can get caught. 20% could go 30%, could go 40%. Microsoft would be a perfect example. It just kind of dies a slow death. Anyway.
How do you feel about the company in a wider perspective? I'm asking because people are now considering with the dip of the tech stocks to buy in now. Would you?
NVIDIA is pretty cheap, and NVIDIA seems to be the go-to name. However, everybody and their uncle owns NVIDIA. We don't, but most people do. AMD was bought because it was relatively cheaper. It could win, in our view, when we acquired it, and we traded a couple times. It could take market share away from any of its competitors. My son's in the technology field, and I'll never forget the day he called me. It was $14, and he said they're going to get 2% penetration in PC chips. They're going to take it away from Intel. And if they go from 1% to 2%, their earnings go up by like 25%. I was like, this is brilliant. Well, the stock went from 14 to 10 before we finished buying, but it began a run. And you look at it in that context, taking market share away, it could be a winner.
Let's get to your third pick then from July of last year, Vermilion Energy, VET on the TSX, 1083 at the time. To 1825, so 69% return and 72% total return. Yeah, you did terribly in this round. I hope you realize, just terrible.
I know.
I don't know how you're going to justify this to your clients. But why Vermilion have you held it?
Yeah, Vermilion is an interesting story because it was last year, it was almost a hated stock. Nobody wanted to own this thing because they'd made an acquisition of natural gas assets in Alberta, number one. Number two, the big story of Vermilion from 5 years ago was their gas assets in Ireland. Gas in Europe trades at a price that's a multiple 2 times at least our North American prices, but that gas field was in decline. And nobody thought they could pull it off to make the acquisition. They added debt. Stock was in the doghouse, but it's a good management team. It's a disciplined management team. And I think part of this run-up has been energy, obviously. But the other part is awareness that this stock was oversold. And so, bingo.
And you've held on to it?
Yeah, it's a great name. It's, again, one of our larger, in fact, I think it is our largest oil and gas producer, but we own gas in the portfolio.
Vermilion Energy there. Okay, let's take another quick break. Lyle Stein of Forvest Global Wealth Management taking your questions on North American and global stocks. Back in a moment. Welcome back. Let's go to an email from John. He says, what is Lyle's opinion on Finning? The stock seems to have stalled after a good run. Is there more upside to the stock? Can you just expand on what Finning does? It's very specific, and I'm wondering to what you attribute the run it's had so far.
Sure. So when we look at Finning, we think of basically a Ford dealer in various locations. Canada, Western Canada in particular, it benefits from the construction going on in the mining and oil and gas world. South America, mining again. They've got some distribution operations, I guess, in the UK. Interesting story, but it's distributing Caterpillar products. We'd rather own Caterpillar as a stock. I mean, you look at the chart, it's had a great run. It's a very stable, could possibly be one of those halo affected companies, but it's not necessarily a halo itself. I would classify Caterpillar as more of a halo, hard asset, low obsolescence than a distributor of Caterpillar. So it's a hard call. Again, I mean, look at this chart. It's done extremely well in 2025. I think that was part of the mining, was part of that cycle. Where does it go? I don't know. I think there's other industrial products. If I was going to play it, we'd much rather own Caterpillar directly in the U.S.
With the infrastructure plays by Ottawa and the interest right now in energy generally around the world, could you bet on some upside for this company?
You could. I think that's a fair bet. This other construction companies could be beneficiaries there. We have to really see how it all plays out. You know, $100 billion, what I think is we're going to spend now on rail. Is that the best use of $100 billion? What's going to happen in the energy patch in Canada? Are we going to change our rules with respect to carbon credits, with respect to taxation? There's a lot of uncertainties out there. Go to the U.S. where there's much less uncertainty when it comes to infrastructure building.
Let's get to another email then from Tim. He says, I've been interested in Palantir for a while, especially for its defense applications, but was late to the party. It's now trading well above its 200-day exponential moving average, but has a 113 PE ratio for PE 84. Do you like it where it is today? And if not, what's a good entry point? So a lot packed in. Palantir has had a run. We know that. Yeah. Let's take a look at where it is today and tell me what you see.
Well, look at that chart. It is tired, not that much different than Microsoft other than the price decline. Again, it's suffering the darling phenomena that many U.S. tech stocks are suffering from. Again, we talked about it since the beginning.
Just not as popular.
And this was the go-to name. I mean, you look at that run since 2025, it's been awesome. And it is the great defense play. The CEO,
they have all the American contracts.
They have great big American contracts. In fact, they're having problems with some of their staff who doesn't necessarily want to do some of the American contracts they have, but that's another story. This name is a hard one to get your head around. So I would suggest take a look at you've got the two PEs, take a look at the estimates behind those PEs. So let's just say the earnings are $1, it's going to go to $2, it's going to go to $3. You're going to look at 200% growth. Compare that to the multiple you pay at. So it's what we used to refer to as the PEG. It's the price earnings relative to growth, and then stack Palantir up. It's going to be a winner, no question about it. The question is there any disappointment in the stock? Is there risk? Again, we just don't own it. We haven't owned a software stock in the portfolio.
Is there an entry point you would look at beyond where it is today?
I haven't studied it close enough to say this is where we'll start to put the pin in. I think there's other software companies that looked interesting. Again, we just can't, play with everybody on the field.
I'm just going to share for him the analysts what they're saying. They have a price target of 193.44, and as you see, it's at 131 today. So just some extra information when you're making that consideration. Let's go to the next email from Ed. He says, in the short term, 3 months, will my gold stocks do better than energy stocks? I'm trading one on a short-term basis. Gold versus energy, I would play them both, but what would you do?
Well, we like hard assets and low obsolescence, and they both kind of fit in there. Again, we think longer term. So if I was going to go stack the two up, this is how we're doing it. Natural gas to us is a long-term play. Canada really benefits from that. Gold is an interesting play from an insurance perspective, and it's insurance against geopolitical concerns. The geopolitical concerns impacting gold tend to be more financial related, tend to be interest rate related. More importantly than that, deficits. What deficits are going to do to real returns and what central banks are going to do. That is a hard thing to handicap, but we do believe deficits are a problem and they're only going to get worse. Therefore, you got to have some gold as protection and you have to have gas. So when you look at the weights in our portfolio, again, I think I mentioned that we're a little bit under 10% in pure oil and gas. We're at 15% when it comes to gold exposure. I can't tell you what's going to happen in the next 3 months.
I was going to say that the term here is quite a short term.
But if I was going to bet, is gold going to, in the next $500 move in gold going to be higher or lower? I would bet that it's going to be higher. If the oil price if it's 100 today, let's just call it 100, is it going to be 80 or 120? I think it could be 80 as opposed to 100, because if it goes to 120, all bets are off everywhere. We're talking global recession.
Let's take a quick break then. We will be back with Lyle Stein in just a moment to take your questions, your phone calls, and your emails. Back in a moment. Welcome back, and thanks for joining us. Victor's on the line. He's in Vaughan, Ontario. He has a question today for Lyle. Victor, go ahead.
Hi, good afternoon. My question is on Thomson Reuters, just to find out, I guess it's been going down lately, and see what's your opinion on this company at the moment. I'll hang up and listen. Thank you.
Thank you. So software concerns eating up many of these companies' share price. Thomson Reuters, one of them. Do you think Thomson Reuters will bounce back from where it is?
Yeah. This stock is a frustrating one. We don't own it. I saw it collapse. Then it had this big rally, and it's rolling over again. I was like, oh man, I was kicking myself because we didn't buy it off off the low. Yeah, off that low. But I did get a chance to start thinking about the big question: is legal software, is financial software dead? Will AI kill it? I think the jury's out. My own work, as I said, I like the law firm of, Claude, Copilot, and Gemini. It's great. So I think it can do things simple stuff. But Thomson Reuters legal business is a bit of a moat around it. So there is true value there. We're going to have fewer lawyers, but the fewer lawyers are going to need access to information. And the best stuff is coming out of people like Thomson, Walter Kluwer's in the UK or in Europe. Yes, I think it'll survive. Now the question is, what do you pay for it, and how much do you pay? I think it's a really intriguing name. This company will be there 10 years from now. This software business isn't going to get totally eaten away by AI. This is, to me, one of those names that's now a value name with growth potential. So, like I said, we don't own it. I looked at it closely. Now I get another kick at the proverbial can.
if you're interested and think it's going to bounce back. Okay.
I think software's been killed.
It has been killed. And what's interesting, I find, is we've kind of digested some of the companies and how at risk they are. We talked about Thomson Reuters and the moat they have, but investors are still not buying into the idea that software could be okay.
Exactly. And the market is crazy as an investor because it's so trading oriented. So next piece of news comes out, bang, sell. Stealing Mr. Kramer's line. But I mean, that's the reality of, I think, the short-term nature of the market. When somebody sell, that's the great chance to buy it when nobody likes it. And that's Warren Buffett's story. So I prefer the latter than the Mr. Kramer.
That was for Victor. Let's go to an email from Frank. What are your thoughts on CoreWeave coming from Frank? What do you think about CoreWeave?
CoreWeave's a play on data centers. And what does data center growth look like? Data center growth was everything. I mean, it was going to drive, everybody wants to build data centers. We'll talk about that a little bit later. The data center growth, though, is now starting to come under question because where's the money going to come from to build these data centers? CoreWeave is a data center provider. Stock has done okay, but it's tired too because I think the oomph in data center construction may be over. How they make money out of that? You know, you've got NVIDIA lending money or, you know, selling stock to buy, for AMD to buy, or not AMD, but Microsoft to buy their chips. I mean, this whole, you know, convoluted
moving around
game.
money from one to the other, yes.
Yeah, and data centers in the middle of that. My own heart says that the data center growth isn't going to be what we thought. Look at the election yesterday, or the political thing in Maine. No data centers in Maine. The people don't like them. Loudoun County, Virginia, more data centers than probably anywhere else in a single location. The people aren't happy. People don't want data centers in their backyard. How that plays out, I don't know. I'll stay away.
CoreWeave and Meta, I understand, have struck a deal. Does that move the mark for you at all on something like CoreWeave?
No, because there's a lot of deals.
There's a lot of these, as we talked about the circular financing. Okay, let's get to Lynn's question in an email. What do you think of investing in SpaceX? And how do you go about investing in SpaceX? You can't do that yet.
No.
But it is coming.
It's coming, and it's hot. Yeah. How you invest, well, you better have a good broker who can get you access to it. There are some alternative people that might be able to get you into it.
How does it work? If you are invested in a company that hasn't debuted yet, how do you get in on it?
Well, I'm going to go, now I'm going to age myself. Going back to the tech wreck of 2000 and 1999, buying hot IPOs was what it was all about. You know, you got into an IPO and it'd be up 30% before the day was ended and maybe 50% later. Those IPOs were allocated by the broker, the underwriters, to their preferred clients. The company does a road show and they say, we want to have these people as investors, da-da-da-da-da-da-da. And so Fidelity gets it, and everybody gets their fair share, and then retail gets a little bit because you want to have a retail participation. So it's just a question of who your broker is. Now they may go, and increasingly we're seeing tech companies in the U.S. doing allocations to the public marketplace, a much more general marketplace. But that's something I just haven't studied because I'm not sure I'm going to pay the price that people want to put on SpaceX. When you start looking at multi- or trillion-dollar valuations, or maybe even more, on something where revenues are all based on a U.S. space program and sending satellites up, I just can't get a fundamental wrap around what Elon Musk has done. But Elon's got a panache. Anyway, what can I say?
Yeah, there are followers who will do whatever.
So I wish I could help you more. It looks very, very expensive. There's other fish out there.
Okay. Let's take a quick break then. We will have new top picks from Lyle when we come back. Stay tuned. Join us tomorrow on Market Call. Rick Rule will be with us on the show, President, CEO of Rule Investment Media. Take your questions tomorrow on natural resource stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Lyle. We're going to start with AltaGas, ALA on the TSX. What do you like about AltaGas?
AltaGas is the perfect halo stock. Hard assets, low obsolescence. When we think of AltaGas, we've got wonderful East Coast U.S. assets. We've got wonderful West Coast Canada assets and a midstream operation in the middle that feeds those West Coast assets. So let's just break it down. Loudoun County, Virginia, we talked about earlier as being data center capital. AltaGas owns the Washington Gas Company, which provides gas to Northern Virginia. Gas is the backup source for all these data centers if the electricity goes out. It's a great demand. They also own something called the Mountain Valley Pipeline, which moves gas from Pennsylvania into the DC area, amongst others. It's a great play on gas, which we've talked about as an intermittent fuel. It's got a hard asset called the utility business, and they think the rate base can grow at 10%. And they're probably more constrained by what the electricity company can do than what the data centers are doing.
We talked a little bit about people not wanting data centers built next door, but these are already underway, already being built.
These are in-place data centers. Yeah, and the issues in Northern Virginia are just like that. But the fact is, backup power is needed for everything else, and we're going to get it. So now go to the West Coast. They export LPGs, liquefied petroleum gas, to Asia. It's an export of Canadian energy to the markets that need it, and it's growing. They started with RIPET. They've got Ridley Island Petroleum Export Terminal or something like that, propane export. Then they've got one called REEF. It's growing, again, very strongly, and they've got very strong midstream operations that provide the natural gas liquids that are being exported. So you got exposure to Asia. You've got an export market. They get a little bit of commodity exposure. It's just well suited for this environment. 2.9% yield, got to have it.
That is AltaGas. Let's get to your next pick, Micron, MU on the NASDAQ. You like this sort of, would you say, in tandem with NVIDIA?
It's a different play. Remember, AI isn't just one single chip. There are inference chips, and Micron is in the inference world, and there's compute chips. Compute chips are the stuff that makes all these large language models. It's the stuff that's been going into the likes of the hyperscalers to build their LLM so that their LLM will dominate the world down the road. But you got to have memory chips to support the compute chips, the inference chips. Micron is the number 3 producer in the world behind Hynix and Samsung. Samsung 1, Hynix 2, Micron through 20%. But it's a global play. Now, this is a really controversial stock because it trades at a 5 times earnings. Most of these stocks are trading at 20 times earnings. Why? Well, because memory, inference chips, is a very cyclical business. If you look at the price of DRAM, it's gone, phew. It's kind of like the oil price as of late. Where does it settle out? Capacity, typically, like any commodity, prices go up, capacity comes in. There's controversy. We look at Micron thinking that we're not going to see a total collapse of memory price because demand is there. And just like oil and gas and just like miners, they're learned the hard way from overspending on capacity when times are good. They're probably not going to spend as much as we think. So it's a cheap play. If they can earn this kind of money, they're going to buy back oodles and boodles of shares. And so it's a complementary play to NVIDIA's of the world.
Micron there. Let's go to Sprott Physical Gold, which is Gold Trust, PHYS, on the TSX. We talked a little bit about gold earlier in the show. Why do you like this play?
Well, this is our insurance policy, as we put it. It's bullion. Now, it's not, we don't tell clients to put bullion in their portfolios. I mean, under the mattress, right? This is a way to participate in a bullion market directly. So we get our physical gold exposure. The gold sits in the Royal Canadian Mint in Ottawa. If you got a lot of it, you can actually convert your shares into physical gold if you really want to. I don't know why anybody wants to hold a bar of gold, but you can't shave it off and go to Loblaws and buy a loaf of bread. But some people do. But it's that diversification tool, that insurance tool, and this is our way of playing it.
So, all right, Sprott Physical Gold, a choice if you're looking that way. Got to leave it there, Lyle. Thank you very much for coming in. Good to see you.
Good to see you, Marla.
And thank you very much for joining us today for Market Call. We'll see you back here again tomorrow.